Good afternoon. This is Ken Long at Tortoise Capital with a review of the weekend trading reports for May 13th, 2017. Happy Mother's Day. Market is in bullish, quiet conditions. On an annual basis, using weekly RSI 14, we're near the upper end of neutral at 68 out of 100. On a 10-day basis, using 10-day NDX, the market's right in the middle of neutral at 51. Price with respect to the 200-day moving average is white bullish at 6.88%. Slope of the 50 has declined to red bearish at 0.1%. ADX remains a neutral reading with respect to the trend at 23.1, but bulls are in charge. The risk index is the 30-period moving average of the VIX divided by the 10-period. 1.0 is the boundary between risk on and risk off. Current reading is at 1.169, so we are in risk on conditions. Riskier assets are favored. We compare that to the last 5,000 trading days and find the risk z-score computes to 1.80, 1.8 standard deviations above the long-term average. This is a 90-day histogram of that indicator. You can see that we had some sideways chop and volatility, a volatility spike which resolved moving from minus 1.5z to plus 2z. It's now rolling over, so the period of easy moves, if there is such a thing, is over. When it rolls over at a distance more than 1 SD from average, that has been a warning to be ready for volatility spikes, to make sure your intraday trading stats are prepared. These are the blended monthly rebalancing holdings in the different ETF portfolios through the 1st of June. These are the current leaders on the basis of closing price on Friday. Theoretical exposure in ETF2 remains at 100%. These are the various looks at blended monthly rebalancing portfolios. You see in ETF 13, most are on buy signals, except for Australia and U.S. real estate, clear leaders in emerging markets and Latin America. ETF 32, we have a few more in the cash signal, gold, energy, and blended commodities. Winners here in, again, Latin America, Brazil, and the BRIC countries. In ETF Max, we're looking at the top shelf of 1,000 ETFs. I look for swing trades for those that are in extreme conditions on 1 week. So things that are all green are ones that are potentially overheated, but certainly a place where I would be willing to reward momentum. The ones that are in red mean that they have been outperforming on 1, 3, and 6 months, but then had a sharp pullback relative performance on 1 week. And so I'm looking for either further collapse or money to come in to buy on a rebound. Those in the yellow were below average, but not quite as sharply down as, in this case, Spain. S&P 500, the same logic applies, only now we're looking at the top relative strength leaders from the S&P 500. I don't see any reds, but plenty of green momentum like Electronic Arts, NVIDIA, Activision certainly stand out. NVIDIA has been just amazing. The market health check, the vertical blue lines are 10, 20, and 30 days worth of look back, and there's the 60-day look back. The horizontal red lines have been support. They were once resistance and are now support. You notice the 30-period regression channel still sloped up, price about in the middle of that channel. The 10-period regression channel also sloping up, price near the bottom of that, right at the edge of the river. The dragon had come out of the river briefly and has rolled over somewhat, so this is a market that is poised to come back and test the Bollinger Band mean in the middle of the river, or the bottom of the river, or the belly of the dragon down here at 2 to 4. And then the floodplain. Those are price targets should price collapse from here. But if this holds, and we're just got to get through 240 for another all-time high. This is a market that last time it was sideways, gave that sharp move up, not without its volatility, however. So this is a market again that's paused to either refresh or could resume. This is where we get paid to be prepared in both directions. You know, the last time the dragon got out of the river and then consolidated, there was a sharp volatility spike followed by a little bit of a gain. So again, we'll be ready for those big sharp moves down like this, but also for some gains like that. So this is certainly a trader's market. You can see the slope of the 30-period regression line here in the sine wave looking thing. The blue dots are showing where that slope went below the zero dotted line and got negative. The swing low of that slope, we crossed back into positive, and now we're at a comfortable upward slope. This is not extraordinary by any means. It has to get above 0.4 for that to occur. So market's in good shape here for another move forward after consolidating this last gain. In the ETF2, look at the regional indices, all around buy signals, so it remains at 100% invested. EFA at 69 is still stronger than the S&P at 60. Inside the U.S., it's technology, large caps, mid caps, small caps. Two weakest sectors being the two strongest, I should say, are the Euros and the technology. Inside the sector spiders, technology exceptionally strong, energy exceptionally weak. In the world market model, most everything in the U.S. is below average except the large caps, which are strong, and then technology the strongest, and even mid-cap growth doing well. Asia less Japan above average, as is Japan. These are the strength leaders in the Asian countries, and just about everything Europe is up and up strong. Mexico and Brazil doing well, Canada lagging a little bit. ETF top 30 according to ETF2. Green in strength and green in consistency is long-term leaders. Green in strength, white in consistency are some emerging strength areas. So the Euros, there's another European 350, and Germany, and Switzerland, and then emerging markets, the EFA small caps, Malaysia, Hong Kong. So plenty to choose from among the emerging strength leaders. In the Dow, emerging strength in Walmart. Declining strength, when you see white and green, that means strength is coming out of what had been a long-term leader. And you see that's almost like a changing of the guard with weakness creeping into United Health, Visa, Cisco, DuPont, and Disney. Shifting to the daily report. Plenty of auto framers, channelings, and overreactions to work with here. I should also say Russell small cap in the channeling signal. Dow Tactical 30, lots of auto framers to choose from, plenty of frogs emerging in these when volatility gets quiet. That's not unusual. The RSI 2 green lights are ones that are 10 or under on that reading, which means they have experienced like a 2-day sell-off and may be poised for a short, sharp 1-day move. Lots of channeling and overreactions and 5DDs to choose from, as well as some 551W. So target-rich environment in the Dow. A little bit less so in the ETFs, with still good number of auto framers and 4 frogs to work with. See the weakness near the top of the stack here in silver, the VIX, and gold. Strength down here, Latin America, Europe, and Brazil really dominating. In the auto framer, half a dozen good symbols to choose from: silver, gold, IBM, VIX, Disney. And then in the regression line fractal framework, these are ones in the top shelf in the green that are the most numbers of ATR below their long-term value, which I use the 270 regression line to mark that off. And the ones in the red are the relative strength leaders. This is how many ATRs beyond their RL270 they've stretched. So McDonald's 9.5 ATRs above its long-term fair value. That's been a real relative strength leader and potentially poised for cooling off. These daily squeeze candidates are ones that are ready for a one-day pop, and that is targets that have had a large average range, but where yesterday or Friday's range was compressed enough so that there's better than a 2-to-1 reward to risk, using yesterday's range as the risk and then a simple range stat move in one day as the reward. And so something like EFA compressed to less than a third, almost just a quarter of its range stat move. So tremendous compression on these ones that are above 3-to-1 for sure. So these are ones that have where the spring has been coiled, and just a large average move would reward on a one day basis. Some market mosaic insights here. You can see the last 30 days, and the slope of the regression line is favorable. Has cooled off a little bit here the last 5 days, and so we've made a nice move off the 1SD, slightly above average now, that slope. In the past, that has led to much bigger moves, but if the market is cooling off and is getting older rather than rejuvenated, then that sort of explains this. There's really only a couple days of follow through in here and then more consolidation. I attribute that to political uncertainty. The standard deviation divided by price, again, this shows the relative pinchiness or the compression of price. You can see we got down to a key -1. Every time it's been getting down to -1, it has responded with sharp upward moves. This one has not really followed through as much as we would expect. So this is, again, something that we're going to monitor closely. Can you see the slope of the 30 is well within historical norms, improving, but not even at +1Z yet. So there's still some room for it to go. So just a quick, you can stop these if you want to look at the stats in greater detail to prepare your targets. Looking at the z-scores of the regression line slopes, the 90, the 30, and the 10. So the 90, which I take to be the longer-term trend, peaked up around z+2, has come back into the region of normal at z1. So this is characteristic of an established bull market that has had one really nice run up, has cooled off, and is now poised for some additional gains. See the 30, which oscillates a couple times here, is now coming up on +1. So this has been a good 30-day move. This was that last 90-day move that was excellent. It paused and then has started to resume. And then we have a narrowed river, price riding the upper edge, well postured for some additional gains. The last time it did this was down in this region, where it gathered strength at the edge of the river and then gave a 20-point surge. That's a 10% move right there. It's decayed, found support at the bottom of the river, one surge holding the top of the river. So in my view, another 10-point move is what we could expect on the upside. A breakdown will come down and test about at 230 in the S&P to hold support. And that's sort of the trading range for right now. Some frog statistics. And holding period statistics. The way to read this is that we'll look at the S&P column over 40, 20, 10, and 5-day look-back periods. So this goes back like 5 years. And the average 40-day holding period for the S&P over a long look-back period has been 1.71%. And so today's reading is 0.82%. So over the last 40 days, the market is up 0.82%, and that's slightly below that longer-term average. And when you look at the standard deviation as 5%, that makes this a z-score of minus 0.13. So it's slightly below average, nothing significant. Over a 20-day period, it's up 1.88%. That's a z-score of 0.22. On a 10-day basis, the average move is 0.43, the current move is 0.13, and the z-score is minus 0.09. And then on a 5-day basis, it's up 0.28%, again, a negative z-score, but a low one. So what that tells you is that on 5, 10, 20, and 40-day holding periods, there is nothing exceptional about this market right now. And because we're in a bull, what that means is that there's plenty of room for upside surges as well as for a downside spike because of the lack of follow-through. So this is a market that is really marking time and waiting for something to either get it moving up or down in a sharp manner. And that's why I'm concerned about the potential for volatility spikes. Okay, so that's everything I wanted to cover. No, actually, there's one more. Let's take a look at it. And that's the BMR volatility. This is a new chart in the stack. All right, so what this is showing is for the different BMR portfolios, this is the individual reporting here, ETF 13, ETF 22 stats, 32. At the bottom, looking at the Dow and the S&P. Just as a matter of course, to understand the difference in volatility in those symbol sets, the biggest one-day performer in the Dow, or biggest one-week performer, is 2.44. The worst was minus 2.76. In the S&P 500, it's plus 25% to minus 15%. So when you expand your search horizon to the larger population, the average is not that much difference, minus 0.56 and minus 0.5, but the extremes in the larger population set, that says a mouthful. And on the blended performance, 40% to minus 23, here it's 26 to minus 9. So you get much smoother and less volatile, of course, with the Dow, not surprising. Similarly, you can now compare the volatility of these individual sets to the blended ETFs themselves. ETF 13, the range is from 5 to minus 1, 13 to minus 2. So you can see under longer time frames, the individual components of the Dow are actually like twice the volatility of the ETF 13. So the ETF 13 performers trade even the relatively quiet volatility of the Dow for the blend of the large indices, making this a conservative data set or a conservative trading population. And now you can see that relative performance of these other sets. So over here I've just put them all and put all the max performers, the maximum of each of those data sets, so you can get a view on what the performance of the superstar in each stack looks like over 1 week, 1 month, 3 months, 6 months. You get a sense of the kinds of moves that are available over these different time frames. And the minimum performers down here, or the worst performing. So the ETF Max tends to be the most violent, although the S&P 500 has maybe more upside. So that's how you read that chart. Just to give you a sense of the performance characteristics of these different pools of symbols. So that's everything from Tortoise Capital. Keep your risk measured and your powder dry.